Hello, Accounting Superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long. And I've got great ways to explain accounting, so welcome aboard here. Today's a beautiful day in Colorado. It's lovely, about 65 degrees, sunny and warm. And so it's a good day to be up in the mountains. So, anyways, what we're doing here is we're trying to figure out whether or not we should eliminate a product line. The Sunset Sailboat Company has a beautiful 15-foot swordfish. They call it the swordfish. And here it is right here. It's a beautiful boat. And but it doesn't look like it's very profitable. It looks like it's losing money, and management is scratching their heads and they're thinking, "Wow, maybe we should just get rid of this swordfish." Well, the thing is, it's a pretty big decision, and the reason why is if you get rid of the swordfish, well, for one thing, what are you going to do in its place? Another thing, if you do shut it down and you decide, gee, that was a bad decision, maybe we should bring it back. It's really hard to bring it back once it's shut down. And also, a lot of people's lives are disrupted. You know, you've got a lot of workers that work on this 15-foot swordfish, so it's a big decision. A lot of people selling the swordfish. A lot of customers. The customers seem to really like the swordfish, but according to this report right here, this income statement, it looks like the swordfish is losing money. Look at this. And so management is very concerned. They're thinking, wow, what are we doing wrong here? Should we just get rid of the swordfish? And so the swordfish here, this 15-foot boat, had revenue of $1 million. And cost of goods sold was $700,000, and they had a gross profit. And then they've got all of these expenses. But I have to tell you, with these expenses, they're not directly related to the swordfish. They can't be pinpointed to the swordfish. Now, cost of goods sold, that more or less can be pinpointed, at least most of it. But these other expenses like advertising can't really be pinpointed to the swordfish. For instance, when the company advertises, they advertise the whole company. They advertise all the boats, not just the 15-foot swordfish. You see, Sunset Sailboat Company sells not only 15-foot boats, but 22-foot boats, 25-foot boats, and so on. And things like office depreciation expense, there's really no relationship, or at least direct relationship, between the depreciation and the swordfish. And so so what I'm trying to say is these selling and administrative costs, they're allocated by the accountant and probably done as well as the accountant can do, but there's no direct relationship. We don't know if the swordfish is causing any of these expenses. And also, if they do get rid of the swordfish, what's going to happen to these expenses? Now, if these expenses are going to stay exactly the same, whether we have the swordfish or not, well, then these expenses are kind of irrelevant in the decision. So let's go down and let's find out some other news. So here's some digging into things, and here's a picture of the accountant right here. So revenue is carefully tracked and is accurate. So in other words, they know that the revenue is good. That's a good number. So going back up here to this income statement, the revenue, $1 million, they know what the sales for the swordfish is. They keep really good track of that. Coming down the list here. Cost of goods sold. Well, direct labor, those are people that work specifically on the boats, building the boats. And direct materials, those are materials that went into these boats, like the fiberglass and the masts and the sails. Now, I've got in red here the manufacturing overhead, and oftentimes manufacturing overhead is allocated. In other words, we can't pinpoint that it was due to the swordfish. And also, in addition to that, chances are really good that if the swordfish is eliminated, that is, they shut down the swordfish, we'll still have that manufacturing overhead. We still have to heat the factory. We still have to supply water to the factory. We still have to have a factory janitor. We still have to have a factory supervisor. So these manufacturing overhead costs are probably not going to change at all, if much at all. So the total of cost of goods sold, $700,000, that matches what is up here on this income statement. So let's read on. Letter C here. Selling and administrative expenses. Sales commissions are directly related to the swordfish. So here's a picture of a used car salesman. I just posted it here just for the sales commissions. So these sales commissions, they know for sure that is due to the swordfish. So in other words, if we get rid of the swordfish, the salespeople won't be able to sell the swordfish, so we won't have any sales commissions, right? You know, you don't have a product, there's no sales commissions to pay. But all other expenses are allocated and are fixed costs. So I've got that in red here. All other expenses are allocated and are fixed costs. So in other words, out of all these expenses here, these selling and administrative expenses, sales commissions right here, that is directly linked to the swordfish. And if we get rid of the swordfish, well, we won't have those sales commissions to worry about. But all these other expenses like advertising and office rent expense and office utilities and so on and so forth, all of those expenses, they're going to stay either way. It doesn't matter if we get rid of the department. Either way, they're going to be there. So how do we figure this out? How do we know for sure if we should get rid of the swordfish? Well, here's how you figure it out. It's pretty cool. So here you go. What we're going to do is we're going to do this small little contribution margin income statement. And it's really pretty easy. And what we want to know is this contribution margin. That's the key right down here. So let's get started. What I'll do is I'll split the screen so we can see two things at once. Here's how this contribution margin statement works. Well, what I have is up in the upper frame here, I guess that's what you call it on Excel, I've got that original income statement, that one that doesn't look so good. And down below, I've got the contribution margin. So all we're going to do is we're going to rearrange the numbers a bit. So revenue, well, since that's tracked very carefully, and we know it's accurate, well, let's include it in there, $1 million. Where'd I get the number? I got it from right there. All right, and then let's come down here and let's figure out this direct labor and all this stuff. So here we go. So the direct labor, that can be assigned or attributed to the swordfish. We know for sure that these people worked on the swordfish. So $300,000, and I got the number right from here. And then direct materials are $250,000. And we'll put that there. Sales commissions, if you remember, the sales commissions are attributed to the swordfish. Here are the sales commissions. So let's put that into place. Now, those are all the costs that we can attribute directly to the swordfish. That is, if we get rid of the swordfish, these costs will also go away. So total up those costs directly assigned, $650,000. So $300,000 plus $250 plus $100 is $650,000. And the contribution margin, here's where the magic happens. And I'm going to unsplit the screen. So unsplitting the screen, here we have the contribution margin. And the number that we're really interested in is this contribution margin. So let's see what we get. So here's how we figure it out. Take our revenue, minus away all these costs that are directly assigned to the swordfish, that we know for sure belong to the swordfish. And if we do a subtraction, we will get $350,000. So what this means is if we shut down the swordfish, we will not get this revenue, but on the good side, we won't have these expenses. But the bad news is that overall, we're going to lose out. We're going to lose out on $350,000 worth of contribution margin. Now, contribution margin means that it's going to help pay for overhead costs, fixed costs, and provide a net income. So we'd be out big time. And the contribution margin percentage is 35%. So in other words, 350,000 divided by a million is 35%. So it looks like it'd be a really bad idea to get rid of the swordfish. Anytime you have a positive contribution margin like we do right here, you don't want to get rid of the product. It's still a good deal. So what would happen if management eliminates the swordfish? Well, net income will be lower if the swordfish is eliminated by 350,000, or in other words, that contribution margin. So if they thought things were bad now, If they got rid of the swordfish, things would be really bad. So the moral of the story is, folks, when you get reports like this, and I know a lot of you are not majoring in accounting, but you'll be managers and that kind of thing. When you get reports like this and you see a big loss here on a product line, you got to wait a minute here and really dig into it deep. And the way to do it is to figure out, well, what costs are directly related to the product and which costs are not, which costs are going to stick around even if we get rid of the product, all right? And because costs that are going to stick around, whether or not you get rid of the product, are irrelevant to your decision. So what you do, in a nutshell, is you simply do a contribution margin statement, and you put down your revenue from your product, and you put down costs that are directly attributed to that product. And these are costs that will also go away if you get rid of the product. And do a little subtraction, you get a contribution margin. If the contribution margin is positive, it might be good to keep the product. If it's negative, probably good to get rid of the product. In this case, we want to keep the product. So I hope this helped. And if it did, let me know. Hit that subscribe button, hit the like button, and check out accountingsuperstars.com. I've got all these videos listed by topic, so they're easy to find. So until next time, over and out.